At Staples Business Advantage, our team of experts can help you find the breakroom products to satisfy everyone's preferences, while AI can
suggest popular items, monitor stock levels, optimize pricing, and automate reordering.
AI can do a lot of things.
But I can never know the taste of a truly great cup of coffee. Sigh.
But you also can't get hangry.
This is true.
At Staples Business Advantage, we help you select from 2,000 breakroom products, so you can be sure there's something for everyone.
Yum. Sign up today and save 20%.
Staples Business Advantage.
Business is
human.
Just as an investor studies a stock before they dive into it, I also urge them to study the index and the ETF before they dive into it. There are some fantastic ETFs available to investors that allow them to adopt a core satellite strategy, to use them in a strategic manner or to use them in a more tactical way. So I'm not dissuading them in any way. I just encourage investors to really do their homework.
G'day and welcome back to Shares for Beginners. I'm Phil Muscatello. What's an index? You've most probably heard of the S&P ASX 200, the S&P 500 and the Dow Jones Industrial Average. How are they created and what do they mean for market prices, ETFs and investing in general? I've decided to find out and go into depth a little bit by asking along today's guest, Simon Karaban. G'day, Simon.
Hi, Phil. How are you?
Good. Simon is a Senior Vice President at Singapore Exchange, which is like the Singapore Stock Exchange, where he leads their indexing business. And before that, he was at S&P Dow Jones Indices. Let's have a look at your time managing the indices at S&P for the S&P ASX series. So this is basically all of these indexes that we see every day, and especially on the nightly news, that's showing how the market has performed on that particular day.
Yeah, that's right. So, Phil, I was working there for Standard & Poor's in the Australian office. I think it was in 2005. And as you are aware, the S&P and ASX have a very firm indexing partnership. And S&P is the index administrator for the broader suite of indices there. So that is the S&P ASX 200, the All Ordinaries Index, the S&P ASX 20, the S&P ASX 50, as well as all the underlying sectors that are linked to these indices. So my role at the time was really to ensure that the number that you see on the news every day is accurately reflected in terms of what has been transpiring in the market on any given day.
Simon, that's what we see every night on the news, isn't it? There's a single number. Every news bulletin just will say, okay, this is what the market did today. That's the number that you're making sure is absolutely correct.
Exactly. So it's a very simple numerical representation of the aggregate performance of the stock market. While it is a very simple representation in numerical format, such as I think today it's about 6,800 or so, there's a lot of work that actually goes into ensuring that that number is accurate and is an accurate reflection of the aggregate performance of the stock market.
So in the time that you were working there, how did things change with the greater take-up of ETFs?
They changed tremendously. So when I started there, it was a fairly standard suite of indices that we're offering to the marketplace. As ETF adoption grew in the Australian market and as investors started allocating more funds towards ETFs, we found that there was a greater demand for new indices that would allow investors to get exposure to different segments of the marketplace. So beyond the S&P ASX 200, for example, there is the development of indices such as high yield indices or high dividend yield indices that allowed ETF issuers to then create an ETF that tracked the performance of the underlying index that was comprised of high dividend paying stocks in the Australian market. There are also several other examples where indices were developed to give you exposure to different sectors as well as themes, which allowed, again, ETFs and the investors allocating towards ETFs to get exposure to different segments of the market, not just in Australia, but globally as well.
So an ETF really can't exist without an index?
No, that's right. So an ETF ultimately tracks the underlying performance of the index. There are a few ETFs, mind you, that do provide exposure to non-index based investments. So there is the rise of active ETFs, for example, but for the large part, or a vast majority of the ETFs in the Australian market are linked to underlying indices.
There's a whole bunch of subsectors as well that a lot of people don't really know about, but there's also indexes or indices, we'll call them indices for now, regarding each particular sector. Like there's a technology index and an industrials and a materials. And this is all part of a business that needs to be managed as well, isn't it?
Yes, absolutely. So one of the important aspects of managing the index, or at least accurately reflecting the nature of the market, is to ensure that we appropriately classify the stocks within the market, because each stock, in terms of its classification, be it financials or resources, experiences a different response to macroeconomic variables. So in the current macroeconomic environment, for example, resources are performing in a very different fashion to financials. And this is extremely valuable information that needs to be managed accordingly within an index. And therefore, this information can be harnessed by investors, so that they can make more informed investment decisions, and they truly understand the underlying drivers of the stock market from a sector perspective.
Yeah, because on any particular day, the market's going to go up or down, but you can drill right down into it and actually see, it's only this particular sector of the market that's performing and not another one.
Yes, that's absolutely right. And in fact, if you look at the composition of the Australian stock market, you'll see that it's heavily comprised of banks and resources stocks. So the index itself is weighted by free float market capitalisation. So what that means is that there is a higher allocation given to the larger stocks, and the larger stocks within the Australian market are obviously your metals and mining stocks as well as financials. So on any given day, you can be pretty certain that the drivers of the underlying performance of the Australian stock market are driven by either the banks or the resources stocks.
And I heard the figure the other day. I think it was like in the S&P ASX 200 is 70% the top 20 companies. Would that be an accurate kind of figure?
Yeah, that sounds about right. Back in my day when I was working in the Australian market, I think it was the S&P ASX 50 that comprised about 70% of the market. But it may well be a lot more top-heavy these days. I haven't looked at the latest statistics, but all being said, and without drilling into the numbers too much, it is a very top-heavy market. So the top stocks within the ASX 200 really do dominate. This is not entirely unique, but it is much more heavily concentrated when you compare it to the S&P 500, which does not suffer from such concentration levels. And what this concentration means is that the Australian market, all else being equal, is perhaps a bit more of a riskier proposition because of these concentration levels. It's not as well diversified relative to, say, the S&P 500.
And the S&P 500 really correlates a lot more with the NASDAQ these days because of the weight of those big technology companies within that index as well.
Yeah, so the nature of the S&P 500 has changed a hell of a lot. It's no longer comprised of the old economy in industrial stocks because of the shift towards technology and growth stocks in recent years.
So how often are indices created? I mean, what sort of rate do they come onto the market and for what reason?
Yeah, look, I mean, indices are very much like any other product that's available in the market. It goes through a continuous series of innovation. Yeah. And, across all of the index providers globally, you could probably say that there's an index launched every day. So, the indexing industry has evolved and changed tremendously, mainly as a result of the fact that they are now linked to financial instruments, and indices are truly investable in the form of ETFs as well as index funds. And when you couple the fact that there has been a rise in product issuance linked to indices with the fact that there is a greater abundance of data available in the marketplace, an abundance of data that is of reasonable quality, that then allows us to create rules-based indices in a far more sophisticated manner than what was done previously.
What was the latest index that you created?
The latest index that we created here at SGX, I believe it was a thematic index linked to the theme of global internet. So it's comprised of companies that derive a lot of their revenue from internet technologies. And, the usual names would pop up in such an index, such as Google, Facebook, Alibaba, so on and so forth. So it's an index, as you can imagine, that has performed tremendously well over the course of the last 5 to 10 years. As I mentioned before, there has been a significant shift towards technology stocks and growth stocks in general. So that was the latest index that we created that was linked to an ETF that is actually listed on Hong Kong Exchange, funnily enough. But we are constantly going through a process whereby we are researching and developing new indices in-house with the view to have them linked to financial products and listed on SGX preferably.
And that's a Singapore Stock Exchange, isn't it?
Correct, yes, that's right.
Let's delve a little bit deeper into the relationship between ETF providers and indexing businesses.
Yeah, sure. So as I mentioned before, indices themselves are rules-based and governed by a set of rules. Therefore, they are very transparent in nature. They do have oversight by a governance committee. Therefore, we ensure that the indices are produced in a very harmonious fashion, which lends themselves to be underlyings for financial products. So what I mean by underlyings for financial products is that an ETF issuer, such as a State Street or a BlackRock or a Van Eck in Australia, for example, will actually mimic the movements of the underlying index by allocating weights to the stocks according to the weights as they're determined by the index themselves. So if, for example, you have an ETF issuer in the Australian market that's tracking the ASX 200, they'll mimic the movements of the ASX 200 by allocating funds that are directly proportional to the weights that are in the index. And then there is obviously the commercial relationship between the index administrator or the index provider as well as the ETF issuer. And that commercial relationship is really through an index licensing arrangement where an index provider will charge an index licensing fee to the ETF issuer for the right to use that index as an underlying for the ETF.
In your experience, are some indices better than others for providing a basis to an ETF?
Oh, absolutely.
Yeah, we had a bit of a chat previously about this, didn't we? But I wasn't sure how far you wanted to go into it live on air, but please, unleash.
Absolutely. Like any products that are available to consumers in the market, some are just better than others, right? So if you look at television sets, some are just made better than others. And some of the producers of television sets actually invest a lot more time and energy into ensuring that the quality is there.
What should consumers be looking out for in this space?
Yeah, one of the biggest concerns around indices, once we go beyond just broad market indices such as the S&P ASX 200 and go into more niche or esoteric areas such as thematic indexing or even factor or smart beta indexing, investors really need to look past the label of the index and truly understand the underlying components of the index. So with the rise of thematic indexing and thematic investing, investors are now piling into different types of ETFs, for example, such as robotics ETFs, biotechnology ETFs. I alluded to the example before of internet technologies. Once you start going down this path, you have to ensure that the index provider is actually offering an accurate representation of that theme. Right. So one of the classic examples that I like to reference is the blockchain ETF or blockchain index. And investors have flocked to this index in the form of ETFs primarily because of the label. So they see blockchain technologies as an emerging technology that will continue to grow and continue to be part of our lives. But the fact of the matter is that there are very few underlying stocks that specialize in this technology. And what you're finding is that it's really the existing technology companies that are dabbling in blockchain. And, they really are just dabbling. I mean, they're not generating a meaningful amount of their revenue from this technology. So you might see a blockchain ETF or a blockchain index that's comprised of companies like Microsoft or NASDAQ, even, or comprised of companies like Google and Facebook, because yes, in their annual report or somewhere along the lines, they've described the fact that they are investing into blockchain technology. But in reality, the risk and return profile of their stock price is not driven by the fact that they're spending a little bit more time, energy, and effort into this area. So investors have to be very careful once they start dabbling into themes or smart beta indices. Another example is the concept of what's known as a quality index. So these are available in the Australian market as well as in our market here at SGX. And what a quality index really aims to do is to choose companies with very sound fundamentals as well as good rates of profitability. What investors need to be wary of is, which financial metrics is the index provider using to find a representation of a quality company? And oftentimes you'll find that they're using financial ratios and metrics that are significantly stale. And beyond the fact that the metrics can be stale, they're also not using the right proxies to be able to address profitability as a factor. So there are a lot of issues in terms of the amount of rigor or the amount of time and energy that's invested into developing such indices to ensure that they're truly representative of the objective or the label that they attach to such indices.
Hey, I'm Ryan Reynolds. At Mint Mobile, we like to do the opposite of what Big Wireless does. They charge you a lot, we charge you a little. So naturally, when they announced they'd be raising their prices due to inflation, we decided to deflate our prices due to not hating you. That's right. We're cutting the price of Mint Unlimited from $30 a month to just $15 a month. Give it a try at mintmobile.com/switch.
New activation and upfront payment for 3-month plan required. Taxes and fees extra. Additional restrictions apply. See mintmobile.com for full terms.
So how can a consumer that doesn't really have much understanding of finance and financial markets, are there any signals or any warning signs that you could give us?
Yeah, look, some of the warning signs, I guess, sensationalism is a problem. So when you see an ETF issuer that has linked an ETF to an underlying index that promises significant returns and promises exposure to the most innovative companies in the world, you have to play the role of devil's advocate. And like I said, you really have to try and dig under the hood at that point to truly understand what makes this ETF or index so special. If you look at the US market, for example, I mean, you just lose count of the number of ETF issuers in that market and the nature and the style of ETFs that are being issued through different types of indices. So, it's something that investors need to study. Just as an investor studies a stock before they dive into it, I also urge them to study the index and the ETF before they dive into it. There are some fantastic ETFs available to investors that allow them to adopt a core satellite strategy, to use them in a strategic manner or to use them in a more tactical way. So I'm not dissuading them in any way. I just encourage investors to really do their homework before they dive into any investment, be it an ETF or a single stock.
And that's the other thing as well, is that some of these ETFs are incredibly sophisticated. I think we've got synthetic ETFs, we've got reverse ETFs. And again, these are things that you've just got to really be wary about as a new investor.
Yes, there are many different types of ETFs. I mean, synthetics, inverse and leveraged ETFs. You've got ETFs that are 100% cash replicated. ETFs aren't just limited to equities exposure. You've got fixed income ETFs as well as ETFs that offer exposure to commodities. And, this is fantastic because ultimately investors now have liquid and transparent access to multiple different types of underlyings and multiple different types of asset classes and strategies, which was traditionally limited or just linked to very expensive managed funds. So all of a sudden, investors now have low-cost access to very transparent vehicles that can give them the same exposure in a much more liquid format.
And it's really important, isn't it, for investors to be getting all sorts of different asset classes, not just buying equities. You might want commodities and, like you referred to as well, fixed income.
Yep, exactly right. So you can almost exclusively manage a multi-asset portfolio now through ETFs. It's not necessarily the case that you need to rely upon managed funds to get your multi-asset exposure. You can do it exclusively through ETFs in a very low-cost fashion. As I mentioned before, because they're liquid and traded on an exchange, you can actually use them a little bit more tactically than you could, say, a managed fund. So if you have a majority of your exposure to the S&P ASX 200, you might say to yourself, look, I'm feeling pretty good about global robotics. I think factories the world over are going to employ robotics even more so as the economy evolves. And you could say to yourself, look, I'm going to have a bit of an exposure to robotics. And the best way to do that is through a vehicle such as an ETF, which is linked to an index that accurately reflects that segment, rather than trying to find those one or two robotics companies globally that could give you the desired exposure.
Yeah, but that's also another interesting thing, that not all robotics ETFs are robotics ETFs. Some of them aren't quite as exposed correctly as, a lot of them will be just investing in companies that actually use robotics rather than companies that are developing robotics.
Yeah, that can be the case. Yeah. And again, this is the important point about understanding the index behind the ETF. So robotics, there's obviously a vertical there in terms of the manufacturers that produce it and as well as the companies that leverage it. So you really have to truly understand the business vertical that the index is trying to address.
And one of the other great uses for an index as well is to benchmark your own portfolio. If your portfolio is not doing as well as, a passive index, what good is it?
Yeah, look, that's a very good point. So indices are produced not just for the purposes of tracking in the form of an ETF, but they're also used for informational purposes as well as benchmarking purposes, as you said. And it's not just a means for you to be able to assess the performance of your own stock portfolio, but it's also a means for you to assess how well your active manager is doing as well. So there are an abundance of managed funds available in the Australian market, which are purchased by investors, be it through superannuation or through just general direct investing, that are tremendously expensive. And studies have shown that while you're giving money to the so-called experts, they tend to underperform the market on a fairly consistent basis. So S&P has a report known as, I think referred to as SPIVA. So it's Standard & Poor's Index versus Active. And I recall, it's true to this day, I'm sure, that I believe it's 2/3 of active managers in the Australian market failed to outperform the S&P ASX 200 index. And those that could outperform the S&P ASX 200 index over a given period of time were not able to persist or consistently outperform in future periods. So there are massive question marks around active managers who charge very exorbitant fees, who either fail to beat the benchmark, or if they do beat the benchmark, just fail to do it on a consistent basis. So the index does act as a very reliable barometer from which you can assess the performance, not of your own portfolio, but also the performance of the active manager.
It's really contributed to the democratisation of investing, isn't it? That we can invest in so many different avenues, so many different sectors, so many different asset allocations just through ETFs.
Yeah, that's exactly right. So you hit the nail on the head there, Phil. I think index investing or ETF investing has really democratized investing for a lot of investors globally, not just in the Australian market. So traditional investments that were once only accessible by private banking clients are now available to just about every investor in the marketplace. And they can access these investments in a very liquid and transparent format through an ETF, which means that They can trade them anytime as long as the market's open for them to be able to do so.
Now, you're the kind of guy most probably that when you're at a barbecue or at some sort of family function, you're going to get asked the questions about investing and, what should I be doing with my money and that sort of thing. It happens to you all. It happens to all of us now, actually.
Yeah.
What's sort of the one piece of advice you give to people when they start to think about investing and what they should be doing with their money?
Yeah, so you're quite right. People ask me what I should invest in, and I just ultimately tell them, Amazon 20 years ago. So, yeah, look, I mean, one of the keys to investing is to ensure that you think about investing for the long term. You think about your investing time horizon and you appropriately invest according to that time horizon. So, for those investors that are, say, in their 30s or in their 40s, they've got a good 20, 25 years of their working life ahead of them. They could be prepared to take a little bit more risk and have greater exposure to Australian equities or global equities, without, allocating, so defensively to fixed income. But really, you should be investing in relation to your risk appetite and your time horizon. And you really should have a sound allocation across multiple asset classes and ensure that you don't panic, you don't overreact. Ensure that, as market moves, that you keep your strategy intact. A lot of investors tend to suffer because they panic, they sell down before they should. When they panic or when things go south, they should think about dollar cost averaging and not just selling out. So I think go into investing with a firm strategy that reflects your risk appetite and make sure that you stick to that strategy and make sure that you have investing rules that you abide by, that you do not react emotionally to, for lack of a better word. So
yeah, manage those emotions.
Exactly, yes. So there are a lot of behavioural biases that emerge, and these behavioural biases take place as a result of the emotions that investors experience. And I think investors, perhaps more recently than ever before, have been investing based on emotion and this concept of fear of missing out. So there's a tremendous amount of speculation in the market at the moment, and you have a lot of investors chasing returns. Ultimately, if you want to be able to sleep at night and you want to be able to have a decent amount of money for retirement, you should certainly follow a very disciplined strategy from the outset.
And often those friends at barbecues, all they want to know is a tip anyway, don't they? And that's not the way to invest. You just can't invest on tips.
No. Look, I mean, everyone's going to have a tip. Everyone's going to have an inkling or a hunch. But ultimately, nobody really knows.
Nobody knows anything, do they, really, about markets?
There's perhaps a handful of investors that have figured out the market. And I'm talking about a handful in amongst billions of people in this planet. So there are a select few that have figured it all out and have invested tremendous time, energy and effort into, finding those golden nuggets. However, for us as average investors, we're better off following a longer term, disciplined approach to investing.
Yeah. Okay, Simon, thank you very much for joining me today. It's been a real pleasure speaking with you.
Most welcome, Phil. It's been great, and thank you again for having me on your show.
Shares for Beginners is for information and educational purposes only. It isn't financial advice, and you shouldn't buy or sell any investments based on what you've heard here. Any opinion or commentary is the view of the speaker only, not Shares for Beginners. This podcast doesn't replace professional advice regarding your personal financial needs, circumstances, or current situation. Thanks to Christopher Soulos for music production with that special Greekalicious flavour. Remember, music always flows, even when the money won't.
This message is brought to you by Maker's Mark. Hi, I'm Michelle Norris, host of the brand new podcast, Your Mama's Kitchen. I'm so excited to partner with Maker's Mark because just like our show, Maker's believes in celebrating the people who have inspired us to pursue our passions. And now, thanks to the Maker's Mark personalized label program, you can create a custom label to celebrate those special loved ones with their own unique Maker's Mark label. And best of all, the label program is free. Go to makersmarkpersonalized.com to order your personalized label today. You must be 21 or older. Labels currently available for 750 milliliter bottles only. Bottle must be purchased separately. Maker's Mark makes their bourbon carefully, so please enjoy it that way. Maker's Mark Kentucky Straight Bourbon Whiskey, 45% alcohol by volume. Copyright 2023 Maker's Mark Distillery Incorporated, Loretto, Kentucky.